It's time to explore the financial benefits associated with the modern-day oil boom that is sweeping the nation. Get ready for Crude Awakenings with Brandon Cox.
Our break-even point per barrel to bring a barrel of oil to the surface is around $35 to $30 per barrel. Anything above and beyond that is, I think the word we use is profit. That's part of our cash flow as a company that we use to go out and acquire other assets to ramp up even more production, which repeats the cycle of adding more cash flow. So, Chris, with prices being where they're at today, how does our cost per barrel relate to some of these other parts of the country that are, well, let's just call out the Bakken Shale here up in North Dakota. You know, we're at 30 to 35 to produce a barrel. What are you seeing up there compared to what we're doing, and how are we in a better, or heck, even let the listeners know if you feel like we're in a worse position than some of those guys up there?
5 to 6 years ago, this would be unattainable, what we're seeing in the Bakken. North Dakota is now, I believe, the number 2 producing state, where before they're pretty much non-existent. So just basically in a 5-year span, based on unconventional drilling, horizontal drilling, and being able to frack, oil reserves that would even equate in the United States is actually, reserves that we could produce from now are there, and we are producing from it. With that said, there's also a bigger cost basis that goes into it. When you're looking at North Dakota, you're looking probably roughly $65 a barrel roughly to get a barrel of oil out of the ground.
Wow, I mean, that's almost twice as much. And, when you start looking at those costs, when you go to the market with that barrel of oil that you bring to the surface, that WTI price is a nationwide thing. Now, we are fortunate enough to have some projects down in Louisiana that get paid on a premium, but, to spend twice as much to get the same oil to the surface and sell it for the same price, work smarter, not harder, right?
Well, I think that's just to get it out of the ground, but then you got to transport that to the refineries on the East Coast and on the West Coast. So, there's an additional transportation cost that definitely lifts that cost basis even further. So,
wow, okay.
Certainly having more of a conventional play in the traditional oil regions, such as the Mid-Continent and Louisiana, certainly with the infrastructure in place, that's another advantage of geographic location that they're operating in.
In my opinion, the only people that are up there playing are the public companies and those people that might be brainwashed or might not understand that there's better places to put your money that are going to generate a higher return on investment because of just common sense. Please be careful if you're just starting to put your toe into the water and look at participating in the oil and gas industry from an investment standpoint and adding that to your portfolio, because there's a lot of places you can get hurt, especially when the media starts grabbing these headlines and starts running with it. You start getting the perception that, hey, that's the best place to be because everybody's there.